Hi, this is Sabarish from SABARI Securities. Welcome to Option Unlocking Series 1, Chapter 3. In today's episode, we will discuss about the concepts of option chain chart. Option chain chart is the visual representation of a auction in a live market. Before we deep dive into options, let's understand few key points. We knew that every stock option or an index option will be assigned a call premium and put premium. Likewise, every options trade has to be closed on or before expiry date. Now, there is a correlation between premium versus time, which is the expiry date. This is very, very important. Please keep this in mind. Every call and put option premiums as the nature to erode nearer the expiration date. This is very important point, which means all the call option and put option premiums of a stock or an index will decrease over a period of time as they approach the expiration date, which we will discuss in detail in the next section. Now, there is a concept called delta. Now, delta is the rate of change of premium with respect to the stock price. We knew that if the stock price increases, the premium also increase, right? If the stock price decreases, the premium value also will decrease. Now, delta measures at what rate the premium value will increase or decrease with respect to the stock price, which we will discuss in the next section. Now, let's look at a sample option chain chart with respect to SBI Bank. SBI Bank is trading at a current market price of 641, right? The first component in option chain is strike price. In options, there are multiple strike prices above and below the current market price. In our case, the SBI Bank is trading at 641. So 640 is the nearest strike price, and above 640 we have multiple strike prices, and below 640 we have multiple strike prices. Now, these strike prices gives the trader a flexibility to trade at any one of them based on their pros and cons, which we will discuss in the next section. Now, the call option premiums are always on the left side and the put option premiums are always on the right side. If you look at the call option, the strikes have been arranged from lower to higher, let's say from 620 to 665, because call option is a positive sentiment indicator, which always expects the stock price to move from low to high. If you look at the put option, the strike prices are arranged from higher to lower, let's say from 665 to 620, since they are a negative sentiment indicator, which always expects the stock price to fall from high price to low price. So call option will have low to high, put option will have high to low. We will discuss this in detail. Now, if you look at these call option and put option premiums, they are segregated into three types. One is in the money, at the money, and out of the money. Right? If you take call option, all the strikes below the current market price is called in the money. The current market price is the at the money. And all the strikes above the market price is called out of the money. If you take the put option, it is just the reverse. All the strikes above the market price for a put option is in the money. The current market price, the strikes closer to the current market price is at the money. And all the strikes below the current market price for a put option is out of the money. Now, all these three categories have got their own set of rules, which we will discuss in detail in the next section. Now, we will understand what is in the money option. Now, in the money option has something called intrinsic value. Please understand carefully, this is very important. Intrinsic value is the built-in profit in a given premium. For example, SBI is trading at 641 and all the strike price below the current market price for a call option is in the money, right? Now let's say a trader is buying a call option of 620 strike, call option of 620 strike, which is trading at a premium of 35 rupees, right? So what it actually means is a buyer is buying an SBI option for 620 rupees, which is actually trading at 640 rupees, right? So, which means there is an intangible profit of 20 rupees already made in this premium of 35, right? So, this 35 rupees premium has got the built-in profit of 20 rupees, which is the intrinsic value, right? And the remaining 15 rupees is the traded premium value, which is called extrinsic value. Extrinsic. So that is why all the in the money call option and put option premiums will have intrinsic value, which is the profit that is already built into it. Clear? Since all the in the money options has an intrinsic value, which is a profit that is already built into it, these in the money premiums will have less premium erosion on the expiry date. Why? Because there is a profit that is going to remain the same even on the day of expiry, but the other extrinsic value might decrease little bit, right? So for example, in our case, on the day of expiry, the 620 call option trading at 35 maybe can fall to 30 rupees because the 20 rupees profit will remain the same and the remaining 15 rupees may erode to, let's say, 10 rupees. So collectively it becomes 30, right? So the important point is in the money premiums will have less premium erosion on the day of expiry because of the intrinsic value that is already built into it. Right, important point. Point number 2, okay, this is point number 1. And point number 3 is because all the in the money premiums has got an intrinsic value, they are expensive or high value. And there is a fourth point. In the money premium will have a delta of 1 is to greater than or equal to 1, which means when SBI stock price moves by 1 point, the in the money call option premiums will also move by 1 point or greater than 1 point, right? So these are the 4 key points that you need to remember when it comes to in the money option. At the money option are the strikes that are nearer to the current market price of a stock. In our example, SBI is trading at 641. So the 640 and so 640 and 645, these two strikes are called at the money strikes. Now at the money premiums will have less premium erosion on the day of expiry. At the money premiums has a delta of 1 is to 0.5, which means for every 1 point move of SBI Bank, the at the money premiums will move by half a point. Now let's discuss the out of the money options. Now if you look at the option chain, for the call option, all the strike below the current market price are called out of the money option, and all the strike above the current market price for a put option is called out of the money option, right? Now very important, out of the money premiums will become worthless on the day of expiry, which means all OTM premiums will become zero on the day of expiry. Very important, because it has got only the extrinsic value, it has got no profits built into it. So that is why all the premiums in out of the money will become zero on the day of expiry. Now since out of the money premiums doesn't have an intrinsic value, they are very cheap to buy. Likewise, out of the money premiums has a delta of 1 is to less than or equal to 0.25. Right. To summarize, so we have this chart here where we have the directional view and the sideways view of the market in 2 columns, and below it we have in the money, at the money and out of the money options. On the left side we have option buyer and option seller. So basically we are trying to understand which of these options would be beneficial for an option buyer or an option seller under different circumstances. If an option buyer chooses an in the money option, let's say his view has become right, then since delta of in the money option is greater than or equal to 1, pace at which the profits are made will also be high, right? And let's say his view has not become right on that day. Let's say he has to wait for 3 or 4 days, and maybe after that his view has become right. And within these 4 days, the premium erosion will not happen with respect to in the money because of the presence of intrinsic value. So time value also will support. For an option seller in a directional market, if he chooses an in the money option, same, the delta will support definitely. If his view becomes right, the premiums will start to erode at the rate of delta of greater than 1. So the profits will be made very quick. Now, with respect to time value, for an option seller, the premiums has to decrease, right? And the time value doesn't support with respect to in the money, where the premiums does not erode, right? So time value will not support. Now let's talk about at the money option. It will be having a same effect as in the money, but the output in terms of performance will be half the rate or compared to in the money, right? If an option buyer chooses at the money option in a directional market, now let's say his view becomes right, the delta will increase by half a point, right? 1:0.5. The pace at which profits are made will be average, so we'll give it a tick. And time value also, and with respect to time value, the premium erosion will be less here. So if an option buyer's view does not go right today, he can still wait, and maybe his view can go right in the next couple of days. Till that point of time, the premium erosion will not happen, so time value will help. An option seller, if he chooses at the money option in a directional market, again the delta will also help because the rate at which the profits are made will be average due to 1:0.5, because the premium erosion happens very less with at the money option. Let's say if an option buyer chooses out of the money option in a directional market, the delta will not support because the delta value is 1:0.25. So the rate at which profits are made is very less, and time value will definitely not support for an option buyer, because if in case he has to wait for his view to become right, he cannot do that with out of the money because the premium erosion will happen very fast. Now from an option seller point of view, in a directional market, if he chooses out of the money option, the delta will have not big impact because of the ratio of 1:0.25, but the time value will play a major role because the premium erosion will be high in the out of the money options. Even in a directional market, for an option seller, if the view does not go right, the time value will still play a major role in eroding the premium, and that will eventually make the position of an option seller to come out in profits. For an option buyer in sideways market, he is not going to make any money because an option buyer always need to have a directional view, right? So in a non-directional sideways market, an option buyer, irrespective of whichever option he is going to choose, will not make any money, so not applicable. Let's say an option seller in a sideways market, if he's going to choose out of the money option, then it will have a very big positive impact because of the time value. As let's say if the price does not move for the whole month, still an option seller can come out in big profits due to higher premium erosion and out of the money. And this is the reason why option sellers always prefer to go with out of the money options. So with respect to in the money and at the money, these options will help only in a directional market, but whereas in a sideways market, only out of the money option for an option seller will be of big help. Hope you have a very clear understanding of the advantages and disadvantages of using different options for both option buyer and option seller. Now, this is the website where one can go and have a look at the option chain chart in live markets to see how the auction takes place. I'll just explain each component one by one. Okay, the link to the website is nseindia.com/option chain, or you can just type it in Google and you will have this link. Now, if you look at here, the first option is the index option, where you can choose Nifty, Fin Nifty, or Bank Nifty. Or if you want to choose a stock option, you can choose from the selected symbols on all the available stocks. The next one is the expiry date. Right? Since here the Nifty is chosen, so we have weekly and monthly expiry. So the next weekly expiry is on 11 Jan. Right? Now, if you look at the charts, as I said, the middle section is the strike price. The left side is the call option, and right side is the put option. Right? Now we have an yellow shadow and a white shadow. Right? So if you look at the call option side on the left side, all the strikes in the yellow shadow are in the money strikes. The strike which is an intersection between yellow and white is at the money, and all the strikes in the white zone is called out of the money for call option. We know that all strike below the current market price for call is in the money, and all the strikes above the market price for call option is out of the money. Likewise, on the put side, just the opposite. The yellow zone, which is the strikes above the current market price for puts, are in the money, and the white zone, which is the strikes which are below the current market price for put option, is out of the money. Right? Now the center is the strike price, and we have a call option on the left, put option on the right. LTP is the premium price, that is last traded price. LTP is the premium for call and put option. Now there are two important components here. One is the OI, change in OI, which is open interest and change in open interest. If you look at OI and change in OI, you will have it in both call option side and put option side. Right? An open interest is the total number of contracts executed by traders, and they are currently in active position, which means these positions have not been closed. Basically, the change in open interest will show if a new contract has been added or an existing contract has been squared off. And the volume is the total trades that takes place in a day. So for every single punch of buy and sell order, that will be considered as individual trade, and collectively how many trades has been executed on a daily basis. We are looking at Nifty option chain, and we always have to look at these charts from a option seller's point of view to understand which strikes they have sold most of the contracts, right? To identify the support and resistance. If you look at the put option OI, which is the last column on the right side, the maximum contract is open on 21,500, which is 267,000 for 592 contracts, right? And if you look at the change in open interest, which is the next column on the right side, there's been a new addition of 1,55,765 contracts added today to this strike, which means 21,500 will be acting as a strong support. Okay. And on the higher side, call side, if you look at the leftmost column, the maximum open interest is built on 21,800 call option with a 2,49,914 contracts, and the change in open interest is also seen on the same strike with 99,601 contract, which means for the expiry on 11th June, 21,500 will be acting as a strong support, and 21,800 on the higher side will be acting as a strong resistance. So Nifty is expected to close anywhere between 21,500 and 21,800 for this week expiry. This is just an inference point only for today. Tomorrow things might change, right? So I believe you have understood all the key concepts in option chain. Again, please go through this video and remember all the points so that it will be easy when we discuss about advanced concepts in the next chapter. Thank you for watching and look forward to chapter 4.